Morning and welcome. Thank you very much for coming. I'm delighted to be here for the launch of the Brand Finance Global 500 and what I hope promises to be a great panel session as well on C-suite partnership for growth. My name's Mike Rocha. I'm the Chief Commercial Officer at Brand Finance. For those of you who aren't aware of Brand Finance, just a brief overview. We began life in 1997 with a mission to bridge the gap between marketing and finance. So we're staffed by accountants, quantitative researchers, qualitative researchers, brand strategists, marketing people, and together sort of serving this mission of bridging the gap between marketing and finance. In terms of what we do for marketers, it's around tools for proactive brand management, solutions for strategic brand challenges, and kind of also helping brands to grow into new areas. All of which is really around taking brand strategy and brand investment and understanding and articulating the impact of that in financial terms to help businesses make decisions, figure out where to invest and how to allocate resource. From a marketing perspective, from a finance perspective, we help to articulate the financial value of intangible assets, particularly brands, and that can be used for a multitude of different applications, including moving IP offshore and setting up tax-efficient holding structures, brand holding companies, for example, valuing intangible assets for negotiation purposes, M&A, putting brands and other intangibles on the balance sheet, and also dispute resolution and expert witness work. We think it's that we have the largest brand value database in the world. Today we're going to be launching and talking about the Global 500, but across the course of the year we publish a very wide range of studies and rankings across many different sectors and many different geographies. And all of that is underpinned by our global brand equity research. So we conduct significant amounts of research with consumers, 175,000 respondents each year across around 40 countries, 30 sectors, looking at 6,000 brands originally. And we've been doing this for 9 years now. So all of the valuations that we talk about are kind of underpinned by that research data. So why do we do this? Why do we kind of promote these studies? Really, what we want to do is promote the value of brands as business assets. This year, the value of the Global 500 reached its highest ever total value of $9.5 trillion. That represents 20% of the total enterprise value of the companies owning those brands. So a fifth of total enterprise value, total business value, is represented by brand assets alone. And the Global 500 grew at, the total value of the Global 500 grew at 10% this year, which far outstripped global growth, which was around 3%. And the value that brands bring to their businesses, I think, can't be better exemplified than through this ETF that we've set up with, that Legal & General have set up. It's through their asset management arm called LGIM, but part of the broader Legal & General insurance group. And this is an ETF that looks at the top 100 brands in the Global 500. And across 2017 to 2025, those top 100 brands delivered 21% higher shareholder yield, 22% higher return on equity, and 20% higher operating margin than their benchmark mega cap peers in the MSCI World Index. So if essentially, brands are significant business assets, and we think that they need to be carefully nurtured and managed just like any other asset in a business, just like your workforce, just like your factories or plant and machinery, whatever it might be. Brand is a key asset and needs that constant nurturing and management just like any other. So we've seen how strong brands can create value for businesses. I just want to sort of touch on how that works in practice. So how do strong brands create financial value? Really, they do it through their influence on profit, growth, and risk. From a valuation perspective, there are only three ways that you can create value, whether it's a business or a brand or any other asset. You've got to make more profit, you've got to grow faster, and you've got to do it more sustainably and at lower risk. These are the three levers that you have to pull in order to create value. So from a branding perspective, strong brands create utility value for consumers or for customers in a B2B context. They enable selection. So by understanding and knowing a brand, it reduces your consideration set. If you're looking at multiple IT service providers, knowing that Infosys is a key global player and is part of your consideration set helps you to sort of save time and focus your energy in a smaller number of potential organizations that you might want to work with. Credibility is key. Strong brands reduce risk, and it's one of the most powerful levers of all, really, in terms of branding, is that trust that we have in brands that we're familiar with and that we know. And that means we're more happy to spend significant amounts of money on that organization because they're not going to let us down. And then the best brands have an emotional connection, drive emotional appeal, and connect with us in some way, either because we align with their values, perhaps, or some other form of kind of association that we want to be part of that brand's world. So these are the three ways that strong brands create utility for customers. In turn, that influences their behavior, so that makes us more likely to choose that brand. It makes us more likely to be loyal or to advocate and recommend that brand, and it makes us more likely to accept the price that brand wants to sell its products and services to us for. And in turn, that drives revenue growth, profit margin, and then reliability of earnings, sustainable earnings, which reduces risk. And these are the three, as I say, levers that ultimately then create value in a brand, but also enable strong brands to create value for their businesses. And so this year, actually, Brand Finance has evolved its brand strength framework. We've rationalized it a little bit. And this is what you see here. So very much aligned to that conceptual model of value creation that I was talking about a moment ago, where we have these brand perceptions and customer behaviors, and we look at the strength of a brand and how well it compares or competes with its competitor set across all of these different factors. And we think that there's not enough time today to go into the full detail of this, and please do kind of get in touch if you want to find out more. But this new framework, we think, is more commercial because we've validated it and we've demonstrated that it is predictive of market share. It's more actionable because we can demonstrate that these are the key levers that we need to pull to drive value. So if we know we're underperforming in certain areas, we know where we need to focus. More focused, so that, as I mentioned, it's a bit more streamlined compared to previous years, and it really allows us to focus on the metrics that matter, and more tailored. So in the past, we used to incorporate a few more corporate level metrics, and now we're very much focusing on brand-specific metrics. And this just illustrates the point I was making about this brand strength as an indicator of future performance. So this is just for one sector. It happens to be supermarkets, but on the x-axis, we have brand strength index, the score, and on the y-axis, we have usage, so essentially a market share. And what we found is that brands that over-index on brand strength are more likely or tend towards higher market share in the following year. So in other words, if you work hard with your brand to strengthen the brand and move it across the chart, then the likelihood is that you will then be able to move up the chart and improve your market share in the future. We also had a look at the strong revenue growth of strong brands. Now, this isn't just the Global 500. This is across all of the brands that we study in our database. And we can see that across a 5-year period, average revenue growth of all brands in our database was 5%. But the strongest brands, so brands with a brand strength index score of 85 plus, which we might call AAA rated, grew at 11% over that 5-year period. So we can kind of spend a lot of time and get worked up about the technicalities of measuring brand strength. But what we also have, things that we hear from our clients is that they do track brand perceptions, but they don't know how to tie that to value creation or what action to take. They need to be agile in terms of how to measure and manage the brand, moving quickly and moving at the speed of that business moves. To be able to navigate the short and the long term, to be able to drive short-term sales while also having an eye on the North Star and building the brand for the long term. And also to find allies across functions. So from a marketing perspective or a brand leader's perspective, a brand these days isn't just built through communication, it's built through the experience across the entire business and across all of the touch points with customers. And that normally requires a marketer to influence and work with closely other functions within the organization to deliver a coherent brand experience. And so the need to work across functions and work with other teams is more important than ever. And this is a theme that we'll be coming back to on the panel. So not just a measurement framework, but I think what I would always, what we advocate at Brand Finance is the need for a management system. So, listening not just to the brand research, but looking out for trends, looking at what's going on in the market, social media, etc. Yes, then doing the measurement piece, but ultimately making sure that our brand leaders work within their organisations across functions to figure out what they actually need to do next on the basis of the measurement that they put in place. Okay, so the reveal, this is the Global 500 top 10 for this year. Apple, the top 4 continue in place as per last year. So Apple, Microsoft, Google, Amazon. I think Apple and Microsoft grew significantly last year, and so they continue to grow, but at slightly more tempered rates. We see Walmart overtaking Samsung, leapfrogging Samsung this year. TikTok actually remain in 7th place, but is one of the most sustained high growth brands in our database. TikTok or Douyin, of course. And a new entrant this year into the top 10 is Nvidia. I suppose no great surprise given the sort of stratospheric growth in their business and in their market cap. Now, I want to dwell on, with the final minutes of the presentation, I just want to set up the panel session. So there's a huge amount of information and data sitting within the Global 500. Obviously, I'm just sharing the top 10 here today. Please do get in touch or register on our website and if you want to find out more. But with that, I'm just going to tee up the panel, if I may. So C-suite partnerships for outsized growth. So ambitious enterprise leaders know brand growth is everyone's business, not just the CMOs. So when the CEO, CFO alignment with the CMO is effective, companies can achieve differentiation, operational efficiency, and a more cohesive customer and employee experience. So that's what we're going to be talking about today. I just want to touch on the CEO and CMO partnership to start with. So this is a study from McKinsey that shows that there's CEOs who place marketing at the core of their growth strategy are twice as likely to deliver annual revenue growth above 5% than those who don't. But we see in Fortune 500 companies, there are 42% of those Fortune 500 companies that don't have a growth or a customer-related role on their executive committee. From the same study, we also see that CEOs and CMOs aren't always on the same page in terms of what the role of marketing is. So the grey squares down the diagonally down that chart of where there is agreement between the CEO and the CMO from the same organisation. And we can see that brand stewardship is really the area of most alignment, but there is significant areas of disagreement within the same organisation as to what the role of marketing is. So Brand Finance launches a study called the Brand Guardianship Index. We'll be actually launching it later this week here at Davos, which looks at the performance of the CEOs of the companies in our Global 500. And here we can see that brands with a brand guardian in the top 100 within our own ranking deliver much faster brand value growth than the rest. So I think that clear opportunity, I think, for CEOs and CMOs to partner. And then, in terms of CFO and CMO, this is a bit of the kind of classic stereotypical debate between, this idea that the CFO is kind of short-term and focused on driving margin, and the CMO wants to spend all the money and build the brand for the long term. And this is kind of what we're going to try and discuss today, if this is really true anymore, and whether actually CFOs, CMOs, CEOs are all really on the same page in terms of the importance of building the brand. I know not everyone at Davos comes from a marketing background, so I just want to clarify some terminology. Performance marketing is, when I say performance marketing, I'm referring to digital campaigns optimized for kind of clicks and sales in the short run, and then brand marketing being marketing that emphasizes storytelling and positioning, isn't necessarily driven directly trying to make a sale immediately, most likely to be more kind of video format and that kind of thing. I think we started about 5 minutes late, so I think I'm actually on track. So we're a long way from this. So I don't know, this is a picture of the Guinness surfer ad. It's often voted as one of the most famous adverts in the world. 20 years after this advert, 72% of 34 to 55-year-olds could still remember this advert, and 57% of them correctly attributed it to Guinness. Most other people thought it was an Old Spice advert. But we're a long way from this these days. We have such a huge fragmented media. We have an incredibly complex media marketing technology stack, and which enables digital marketing, which enables performance marketing, and everything is measurable within this sort of ecosystem. So it's very alluring, because at whatever we spend, we can measure the impact. A client of mine working for an automotive brand was saying that they can. He's responsible for the brand, but he's also responsible for sales, and the fact that they can track the money spent on digital advertising through to clicks, through to test drive sign-ups, through to sale, that is incredibly alluring compared to putting some money into telling everyone what you're about as a brand, but not necessarily driving sales. So we have this tension that's driven by the marketing technology that's available to us. And yet we still, there's a growing body of evidence about how strong brands work and why brand building works over the long term. In particular, Thinking Fast and Slow, Daniel Kahneman, How Brands Grow, Byron Sharp. But our understanding of how the brain works and how strong brands work has never been more in depth and more understood. The IPA, which is the Institute of Practitioners of Advertising in the UK, have a very well-known study called The Long and Short of It, where they've looked at the effectiveness of a variety of campaigns and demonstrated that the optimal balance between brand spending and performance marketing is 60-40 in consumer B2C and 40-60 in B2B. And also, the probability of conversion improves when you have brand and performance together versus just performance marketing on its own, also from the IPA. And yet, this study from Ubiquity about marketers' predictions for 2025, there is a marketers are predicting they're going to spend more money on performance marketing this year compared to last year, with a big increase in those predicting they're going to spend money on performance marketing. So these tensions and this are still out there, and many marketers are going into, and organisations are pushing into the performance marketing space because of that measurability. There are some brands who are sort of standing out from the crowd a little bit. We've got Nike and Adidas both kind of coming out and being quite publicly stating that they are not going go down that route. They're going to build their brands and invest in brand building. But Airbnb is the case study I just wanted to briefly talk about before we go to the panel, which now Brian Chesky, the co-founder of Airbnb, talks about performance marketing as a laser, where you can light up a particular part of a room, brand marketing as a chandelier, which lights up the whole room. And when Airbnb is a fascinating case because in COVID, and I hope you can see this, it's a little bit detailed, this chart, apologies. In COVID, obviously everything collapsed, marketing budgets collapsed, and Airbnb pivoted to brand marketing. So marketing spend dropped, but they made a big announcement that they were going to shift a lot of their budget into brand building, which made sense while no one was buying, travel. So brand value dropped. That's EBITDA and revenue. So profits went through the floor. But with this shift here to brand marketing, whilst we were still in the pandemic, led to a huge spike in consideration and familiarity for the brand, whilst maintaining lower levels of marketing, but with a shift to brand over performance. And we could start to see profits improve, brand value start to improve, and revenue starting to improve over that time period. And then they've really doubled down on that. You could argue that COVID was a period where it just forced them to go into brand marketing, but they have continued that post-COVID, continuing to increase their spend, and then with very positive results across revenue, brand value, and EBIT margin as well. So I think there are, last piece, Deutsche Telekom is another brand I just want to call out as really sort of emphasising its brand. This is from its Capital Markets Day in 2024, and this is the CMO talking about the most valuable telecom brand in the world. But this is the first time Deutsche Telekom had ever had a 15-minute dedicated session to brand in an investor day. So they're starting to see the importance of driving and communicating their brand across all audiences. And he was actually kind of pretty out there in terms of we're not a business running a brand, we're a brand running a business. So, with that, hopefully that's kind of set up the session in terms of the C-suite partnership and how CEOs, CMOs, CFOs can work together. I'd like to welcome Sumit Virmani to the stage, Chief Marketing Officer from Infosys, Jonquil Hackenberg, CEO of Ellen MacArthur Foundation, and Jared DiPalma, CFO of Dow Jones. Okay. So Infosys is hosting us. I feel like it's appropriate to start with you, Sumit, if that's okay. Put you on the spot first. So Infosys, congratulations to Infosys, fastest growing IT services brand over the last 5 years, jumping from 145th to 132nd place on the Global 500. Can you just tell us a little bit about kind of what's made that growth possible?
So first of all, Mike, thank you. Thank you for Brand Finance recognizing this journey of brand Infosys, and good to kick off Davos on a brand note. Usually you kick off Davos on the geopolitical and economic reality shifting our worlds, but from the presentation that you just shared clearly, brands playing an important role in all the shifts that are being driven around the world. So good to be sitting here and talking about that. Now, our journey has been rewarding, and we were glad that that journey has been so fulfilling in the process as well. But to your question, uh, to sustain a brand growth over years and over decades has to at some point start with the business realizing how important this intangible asset is for the long term success of the business. So the way we think about it, it's the confluence of promise, purpose, and performance. Uh, for brands that actually have to sustain and be timeless, they have to bring the confluence of these three elements together. You need to really have a promise that stands the test of time, in some sense, keeps you honest, keeps you fresh, keeps you pushing to evolve with times. And our promise happens to be Navigate Your Next, which is about helping our clients successfully navigate every turn of technology. And we do know between us, technology has been on an override the last few years, and how a brand keeps pushing the boundaries of business by innovating, by triggering offerings and products that are helping our clients succeed in navigating this turn. The same thing is about purpose. In fact, this morning I started my day with the launch of the Element Trust Barometer just about 200 yards from here, and there is a crisis of trust, there's a crisis of confidence, and possibly for the first time in the last few years, the trust in businesses has fallen dramatically. That essentially means that businesses or brands that are not putting larger societal considerations at the core of their narrative are not going to successfully navigate. And that is something that for Infosys early on, the founders came up with a view that brands exist to really fulfill the larger societal needs as much as they exist to drive growth and profits. And that's been at the heart of our foray into aspects like education, skilling, sustainability. We have an expert who will possibly talk more about that a little later, but those have been very integral to our journey as a brand, not just innovating with technology. And finally, really bring back to the point you closed with. It's good to have great promises. It's fantastic to have a great purpose. Then we have friends like a CFO sitting in the room who would like those larger intent translate into performance. So how can marketing keep its eye on the ball in terms of enabling short-term growth while preparing the grounds for long-term growth, having the right kind of metrics to enable that? I think the confluence of these factors really have been what's triggered the success of Brand Infosys.
Great, thank you. Jonquil, we're talking of purpose-led organisations. Ellen MacArthur Foundation. Perhaps you can tell everyone a little bit about what the foundation does, but sustainability, it's a very kind of crowded space these days. So I'm interested to understand, how do you try and cut through the noise? How do you try and maintain the relevance of your brand?
Yeah, sure. So I'm just CEO since November, so I can't take any credit for everything that's happened today at all. Maybe the last 2 months, that's about it, not even that. So the Ellen MacArthur Foundation is really about, it's not about sailing, in case anyone knows Ellen MacArthur, which I often have to lead with, interestingly, on brand. It's about the circular economy, and it's really creating growth around impact and growing differently. So growth doesn't necessarily have to mean growing more in numbers, but just growing differently within planetary boundaries. And what we focus on is predominantly on what is the circular economy, and to date that means that through our work, 75 countries in the world have a strategic roadmap around circular economy, and 55% of businesses have a circular economy strategy. So it's really been about going broad so far, and we've gone deep on plastic packaging. We work with governments and with brands really around the UN treaty around plastics to reduce, have a cap on virgin plastics. But we're also doubling down traditionally on food and fashion, which is going to evolve into consumer products, and the technology role in that, and the role of AI and machine learning around consumer marketing, but also on critical raw materials. So in this noisy space around, let's call it sustainability or climate, we've traditionally always gone around what's the economic value and the opportunity, rather than we've got to reduce. It's really about keeping materials in circulation so that we're not extracting more and more eternally. And I think that narrative's really critical moving forward, particularly with the new administration in the US, looking at material security as much as, keeping materials in use. So really material security within the context of consumer products, but also within critical raw materials, both for energy transition and beyond, is really where we're going to focus.
Is that economic value as in the business case for organisations to become more circular, and what's in it for them from a business
absolutely
perspective? Okay.
So interestingly, last night, so I was at a intent dinner last night, and Jesper from the CEO of IKEA, he was talking about he said, look, the circular economy is not yet a thing. It's not like ubiquitous. It's really been a framework to date. And really our moving forward is, what is that story and what's the vision, the brand marketing, what's the vision of what an end state circular world looks like? And what he said is, it's not ubiquitous, but every time IKEA touches circular economy, they save money. Simple as that. So it's a value creation opportunity, but it's a money saving opportunity as well.
Great. And Jared, I'm very interested to hear from you as the CFO on the platform, and I'm interested in understanding a bit about the discussions that happen within Dow Jones between CEO, CMO, CFO. What are the kind of, in terms of when you're talking about the brand and reputation of the organisation or of some of the brands within the portfolio, how does that? What are the respective roles of each of those? The people that we've been talking about today in doing that.
I mean, we're very fortunate at Dow Jones to have heritage brands going back to 1882, and there's such amazing equity and convening power, and you'll see that this week if you stop by the Journal House. But with that, also there's a very delicate and fragile environment that starts with the CEO, and how does he or she, as a steward of that brand, define the priorities and the vision for what it needs to be in the future. And that's what our CEO does every day with us. Our CMO, how do you then take that vision and translate it, prioritize it for the brand, especially when you have a house of brands like we do, and making sure the architecture where those brands sit are placed correctly. And then the CFO is, okay, how do we allocate capital toward that brand vision? And at Dow Jones, there's two categories, like you discussed. There's what do we put toward performance marketing, which is very tactical, very easy to measure ROI on, and then there's the brand marketing, and how much do we put toward that, which is a little bit trickier to measure in the short term. But as you're changing your suite of products, it's critical to help change the perception of what your company is.
And what are you looking for as a CFO when it comes to either performance marketing or brand marketing in terms of metrics, ROI, or that kind of thing?
For performance marketing for our business, it's pretty simple. Every dollar in, you want to see a result as if it comes to a direct subscriber to one of our editorial products. On the brand marketing side, it's market share. We have a large data and information business that is doing really well, but penetrating new markets, so you can start very easily mapping where you're putting your brand marketing, how you're trying to chip away at the market share. That takes a little longer to measure than performance marketing, but I think the connection between the marketing and the finance teams, as far as what data, what metrics are we going to measure starting on day one, is the best way to start that relationship, because then you're very clear about where you're going to have wins, you're going to have course corrections along the way, but setting that baseline is always the recipe for success.
And can I suggest brand value, maybe another
Yes.
KPI I want to introduce in the future? Sumit, you were talking about balancing short-term and long-term, I think, a moment ago. Could you just kind of go into that kind of a bit more deeply? How do you do that at Infosys, and does the sort of marketing technology stack and AI and the things that we would kind of alluding to in the presentation, are they helping to get to manage those tensions between short and long term?
I think helping would be an understatement, because clearly they're at the core of really making real, marketing real for the business. And I think you touched upon that a little bit when you introduced the idea of brand marketing and performance marketing, and that's really one conundrum that most CEOs and CMOs are in the recent past driven by, because we're really coming off an economic world where growth has been hard to come by. And when growth is hard to come by, it's very easy to look at just the short-term playbook of marketing dollars converting into revenue, rather than a playbook which is 3 or 5 years long, where you continue investing in the brand through that downturn. And at least something that we've been fortunate to have the support of the C-suite is to really balance our matrix both towards short and long term. So we have a well-defined set of metrics which are driven by how will it translate into a quarterly funnel, how will it translate into win rate for the year. And that is something that defines the allocation that we do for the short term. But then again, as your data and many other research data over the years have proven, that consistent investment in brand not just drives long-term market share gains, to Jared's point, but they've been shown to drive long-term shareholder gains, a much higher price premium that stronger brands drive vis-a-vis weaker ones. So I think that realization has to be understood early on, and those metrics have to be defined both for the short and the long term. And that is something, at least over the last 5 years or so, we feel we have kept a laser sharp focused on, so that the allocation might change depending on the priorities of the year, but the balance between the two is always maintained.
And actually, last year when we were on this platform, we were talking about sustainability and the role of sustainability in driving trust and the risks of greenwashing. And so I just wanted to ask you, Jonquil, is greenwashing a concern for the foundation? Is your brand kind of being placed next to corporate brands, and do you have to sort of manage your reputation in that way, in that sense, and somehow make sure, or police, or monitor somehow that risk of greenwashing among corporates?
So I would say rather that our opportunity with the Ellen MacArthur Foundation is really to bring to bear the reality through proof points of either innovation or advocacy. So brands and organisations associating themselves with us, I mean, we thrive on network and partnerships, means that they can actually demonstrate this demonstrable action, which then helps them navigate away from greenwashing, because they're investing in an organisation with good brand reputation that is actually driving things forward, whether that be policy or whether that be the nexus of innovation. So, for example, we're doing a food challenge at the moment. So around how do we have biodiversity and nature loss? How through upstream food design, introducing different ingredients upstream to create a new market, can send new market signals, which then enables farmers to sell different products. We've got something like 12 different countries involved, 140 brands, 60 brands, 140 products, and they're using a logo, or they can use the logo or phrase "with nature in mind." That it's launching at the end of January, and these products are going to be available in Waitrose, in several other supermarkets around the world, in Brazil and the US. And the point being, we had a real debate around what language we use around "with nature in mind," so that there is no greenwashing risk for the brands that are involved. And it's indicative of what we're actually trying to do in terms of the challenge itself.
Okay.
And Mike, if I may, I think we've traveled quite a distance from the conversations we were possibly having last couple of years, because if you look at data today, I think well over 90% of consumers are actually choosing a sustainable lifestyle. So I think it's quite real now that the convergence of marketing and sustainability is going to be on every CMO's agenda. It is not going to be something that it happening in a pocket of an organization. It has to end up becoming a fairly integrated narrative for any brand which actually chooses to prioritize business and business growth.
And what's the sort of, in terms of Dow Jones and sustainability, what's the kind of role it plays within that organisation?
We as News Corp, our corporate parent, has a big initiative and tracks it from a tactical standpoint. We still deliver newspapers every day. There's a big supply chain that we have to monitor and figure out the most green way to deliver that paper to everyone's doorstep every day. So it's part of our corporate culture.
And just coming back to the sort of piece around budget setting and that kind of thing. I'm just wondering, could you you talked a little bit about the budget setting process. Just how does that work within Dow Jones? How do you kind of manage those tensions, and how do you figure out where, how much to place on performance, how much on brand, and across the different brands within the portfolio?
Yeah, we start early, and it's like I said earlier, it's the most important thing. And when I was in my last role with a company, marketing actually was part of the finance organization, which is very unconventional. And what I found in having that in one is that data and insight helped drive so much more clarity on not only what the marketing organization was going to do, but also help finance then argue, back up what capital they were going to put toward the various initiatives. So the most important step in any budgeting process is just to be able to start with the priorities, determine what data and insight you're going to use to measure the success on achieving those priorities, and then aligning the budgeted capital along with it. And for me, that always gives me a clear line of sight, right, on then how much to put toward a certain area.
What do you think of them? And this is a question for both of you. What do you think are the biggest misconceptions about this CFO, CMO tussle? Is it real? Is it actually everyone's on the same team?
He always asks. I always say no. That's the misconception.
Yeah, I mean, what is it? What are the biggest misconceptions, do you think? And then and how do you think, Jared in particular, marketers can make themselves more accountable from a financial perspective and make their case more strongly and more effectively with CFOs?
Okay, so I can go and you can add Jared. Yeah. So I think that the biggest fallacy is that CFOs don't understand brand. I think it's whether it's CFOs or any other C-suite participant, businesses are not charities. They're driven by the intent of creating shareholder returns, growth, and profitability. That's a given. So if you're, as a marketer, operating in an environment where you content yourself with vanity metrics that only marketing organization understand and the rest of the business struggles to understand, there would be a real tussle between marketing and the CFO, because those metrics don't necessarily point to the metrics that business success is governed by. However, if marketing as an organization evolves itself, sticks its neck out, and actually takes on bottom line for driving short-term and long-term, and drives that narrative with the C-suite, including the CFO, at least I have seen that drives a fair amount of trust upfront within the conversation between the CMO and the CFO. And the example that even Jared alluded to, it was the matrix alignment is the key. If you're aligning matrix which the rest of the C-suite appreciates, while you can continue to have your vanity metrics in the pocket for the rest of the marketing organization to appreciate and understand, because some of them are lag metrics or the lead metrics that deliver business metrics, I think we'll all be better off.
Yeah. And I would even argue that some of the vanity metrics could all be mapped toward a hard metric. I look at the brand value of the assets I'm aligned to now, and I then look at the pricing metrics, and you just see it come through over time as far as how you rack and stack to your competitors. So you could always, and that's where the CMO CFO partnership works well, is that together you could figure out how to map those because one obviously has more line of sight and access to more of the hard data versus the more qualitative information that the CMO office would have. The other thing I would say is the torture of a CFO at times, especially if you're a publicly traded company or the largest division of a publicly traded company, is there is that tactical short-term balance that you have to manage for quarterly earnings every year. So if sometimes your CFO says, I just can't do it, it's not because they don't believe in what your organization is about. It's because there's a fiduciary responsibility to hit a certain number for the quarter that sometimes you just got to manage through. So take that into account.
Is that a tension, do you think, that brand building investments typically pay off over the longer term, but quite often the senior, the C-suite are incentivized over shorter term metrics? Is that a sort of a source of tension potentially, or a reason why budget may be diverted away from kind of the longer term brand building?
See, I would. I spend a fair amount of time with a lot of global CMOs by virtue of being in this role, and you're right. There isn't universal appreciation for the right balance between short term and long term. Some organizations are more driven by here and now, and potentially that's the reason why you see marketing pivoting more towards performance marketing than pivoting towards long-term brand. It's not universal. It's not that we have arrived at a situation where there's universal appreciation that brand drives long-term market share growth and profitability, and that, in my view, is the CMO's challenge and an opportunity, because that's where I know for us it was not a cakewalk on day one. There was no appreciation on day one, and over a period of time you have to actually bring in a lot of external data, build that narrative while slowly balancing and educating. So educating the C-suite is also marketing responsibility in a scenario where this is not instantly seen, and that is the reason why like Jared said, the realities of public markets is not going to change. We are publicly listed companies with quarterly earnings under pressure, and there's a commitment to deliver for the shareholders, and that's why the right balance is critical. But I think most organizations and most C-suite leaders have been through this journey and can appreciate the right narrative backed by enough research and enough data.
Yeah. I think you're. The only thing I would add is, performance marketing. It's a lot easier to measure in the short term. But we've even had examples this past year where we've moved brand marketing in based on the news cycle because we felt that there would be so much more bang for your buck if we launched our campaign aligned to dynamics going on externally. So we'll even make short-term decisions on brand marketing timing, knowing that long-term it takes a little bit more to see the results of that spend.
And coming back to the Ellen MacArthur Foundation brand, I was thinking that having a well-known name associated with that foundation might bring advantages and challenges. I mean, well known to me, although I was speaking to a colleague of mine over dinner earlier this week who had no idea who Ellen MacArthur was. So there is a generational differences potentially, but also she's very associated with sailing, obviously. So just interested from a brand management perspective, does that association with Ellen MacArthur, back to the theory we were talking about, it drives that familiarity and potentially credibility and trust, but does it create any sort of tensions that you have to navigate her sort of celebrity status, I suppose, as it were?
Yeah, absolutely. So I'd say having her name within the organisation is a huge draw, because she's known not only for being a sailor, but being for a very authentic human who will drive so much to build success. I was talking to Paul Polman last night, and he said, I remember the first meeting we had with him. Yeah. And he said the first meeting he had, the ferry was cancelled, so she just sailed there to explain why circular economy was critical. And he said, we're in because this woman is really committed to what she's talking about. So it's a huge draw. And as I said at the beginning, I often have to, preface several conversations with, it's nothing to do with sailing. I'm a sailor as well. So some people are like, oh, this must be amazing for you because you get to do sailing. Like, no, it's nothing to do with sailing. So, yeah, it's a challenge. But then when you start to tell the story, the long-term story and the vision set against shorter-term performance metrics, it allows to build in the picture of what the long-term vision is. And her name of what that long-term vision means really helps in that regard.
I think we've got about 10 minutes to go. I just want to open the questions to the floor. If anyone does have any questions for the panel around this discussion. So I just put you on the spot there. Everyone out there?
Sorry. Hi, Natalia Arthila. I came in a little late, so I hope you didn't cover this, but I just wanted to know how you define maybe KPIs that are aligned between brand and marketing. I know those are difficult, but I think having marketing talking about ROIs that are relevant to revenue, and again, educating us to do that, I think is important. So I'd love to know how you align KPIs amongst each other.
No question.
Sure, and I think we did touch upon it briefly, Natalia, but thank you for the question. I guess we talked about the dimension of short-term versus long-term, and short-term metrics around marketing are largely driven around pipeline and growth and winnability, because that's what the rest of the business appreciates and understands, and you can actually tag it back to quarterly performance and annual performance. But then again, a brand, as we all know, is not something that delivers results in a jiffy. It takes years and sometimes decades to drive that. So you need to have lead metrics, which are all around familiarity, consideration, advocacy, something you saw Mike, or possibly you didn't see Mike talk about. But then again, how are those trending towards driving market share growth? How are those trending towards delivering a price premium vis-a-vis the industry, or how are those trending towards shareholder returns vis-a-vis the industry? Those are the long-term brand metrics, and that's why the balance between short and long-term becomes really important.
I think from a brand finance perspective, the key thing that we always try to do is make sure that whatever we're measuring, we ultimately try and connect it back to the business model of the client we're dealing with. So if it's a telecoms organization, the key KPIs that are going to drive revenue and value creation for that organization will be a customer acquisition, customer churn, and ARPU. For Dow Jones, you mentioned earlier on, a key metric is uptake of subscribers, and you'll also have minimizing churn of subscribers through making sure that the content is of a great quality. From an Infosys perspective, it might be size of deal or share of wallet, because many of your clients will work with various providers. So for me, it's kind of the way we approach it at Brand Finance is making sure that it's as relevant as possible by ensuring we understand the business model and tie it to those value creation levers within the business model. Any other questions?
Thank you. It's been really interesting hearing about how you can actually connect in practice the CMO and CFO, but I'm really interested to hear about the people that support the CMO and support the CFO, their relevant teams. Do you think that there's more opportunity for them to collaborate, and if so, how does that come to life?
Sure. So at Dow Jones, within my finance organization, there is a specific group that supports exclusively the marketing organization. And then within our marketing organization, there's almost a pricing function that skews more quantitative that will link with them to drive a lot of the modeling to make some of the performance marketing decisions or the brand investment. So those two groups are really attached at the hip and work exclusively together on the analysis. So whenever we do the analysis, what's great is that it's coming from both organizations, being presented to both myself and the CMO.
No, I think I'll just add that yes, I wish it was as simple as just the CMO and CFO talking 3 times a year and the collaboration gets done. It's the people working with us who are mapped and who actually do this on an ongoing basis. Because if you're really in the process of educating an entire function, then it has to be not just a simple alignment in metrics, but a day-to-day working as well, because that's when the true collaboration between team happens. So yes, a lot of hard work by them, but yes, that doesn't take away the 3 times a year mandatory chat over a cup of coffee to align on the metrics.
And if I may, I think the opportunity between CMO, which is effectively telling the story of your brand, right, both long-term and short-term, and the CFO is delivering the numbers against that. So aligning the whole organisation around kind of hard facts and story is what's driving your success, because it's telling your chapters. You look at your quarterly results as simple chapters as to where the story is going over time, is a real opportunity to bring an organisation together and pull in the right direction.
That's such a great
Nicely
point.
done.
Yep.
Nicely done.
I had a question around how you measure brand as well as performance in respect to events. So if you own the event, or for instance, all of us in the room who are marketers and justifying the spend to be here today. And then also how you look at that in terms of market share for measuring brand and performance marketing with respect to events you choose not to go to that maybe your competitors might be.
So at least I can go and I'm sure all of us are in the business of spending a lot of time at events. And the reason why we come over and over to even Davos, I mean, I'm coming here for a decade. I'm sure many of you have been here much longer, is because we see real value than just attending CMO, CFO conversations early in the morning, right? So for us, again, there are metrics that we look at from a perspective of, like, one of the big objectives for us coming here is to meet a lot of our existing and prospective clients. So how many do we engage with, and how is that engagement and advocacy then translating into potential opportunities over the rest of the year? Something like that, but does not, it might start at Davos, but goes on all the way into the rest of the year, to keeping a very, very close track on that. At the end of the day, all channels, whether it's events or other channels that we use, ultimately have, like Jared mentioned earlier in the conversations, we have a ton of marketing only metrics, but all of those marketing only metrics eventually converge towards driving short-term growth, long-term premium, long-term market share gains. And every single channel has to be fed back, and that's where the role of marketing technology comes into play, because that gives you the ability of being able to minutely look at a conversation, a transaction, and feed it back into the performance cycle. So yes, it has to be measured, because they end up becoming a very important channel.
So,
Don't worry if you...
Not enough events.
Thank you. So I have a question about data. We know that data is very important, especially to analyze the business. How do you handle the ownership of data, the one source of the truth? Which team is owning what? How do you handle the governance, especially when we have new tools as well? Typically, it's always like, is it commercial teams or marketing or finance owning the data, or how do you handle that topic?
Jared, do you want to go there? You have a huge play in data.
yeah, I've seen it work best when the data. One, you trust the data. You have a foundation of data. You have a data lake, if you will, that everyone, where all your information sits, and that's usually owned by your technology organization, and they are responsible for making sure it's all encompassing and accurate. We talked a lot about KPIs. That's the top of that funnel, or the top of that pyramid, I should say, with where all the data comes from, and that needs to be throughout your executive leadership team. Everyone agrees on what those key KPIs are. where I've seen the measurement and the results of that information work best is when there is one single source of truth. We're in Switzerland, if you will, of this is where we are at a given point in time, whether it's the year, the quarter, and it's presented in a very clear, simple manner without any qualitative spin around it. And I think that's where some organizations get in trouble, is that people get hands on the raw data, the metrics, and then they start coloring it in one way or the other to tell a story. There's always time for storytelling, but before that happens, what are the hard facts? And if you have one group, it doesn't matter where it sits, whether it sits in finance or CMO or even if it's a data and research organization that reports right into your CEO, who ultimately is going to present without question, without debate, here are the results. And then you go from there.
Okay, I've promised Jonquil that we will finish at 5 past to let her go, make sure she can get to her next event. So I'm going to honour that commitment and bring this session to a close. I'd like to thank our panel very much indeed for agreeing to come and talk. And thank you all as well.